Hello everyone. My name is Vikas Agrawal, and I'm the founder of a company called AIF and PMS Experts India. So AIF is your alternate investment funds, and PMS is portfolio management services. And we are now emerging as one of the largest platform for investing in alternate investment funds and portfolio management services. So, at AIF and PMS Experts India, the whole idea of this platform is to basically ensure that all our investors gets a lot of value addition in terms of getting knowledge, what's happening in the market, and also we make them aware about if there is any opportunity which is there in the markets. So, at AIF and PMS, we run this show called Ask the Expert, where we invite industry experts and we try and read their mind. So with me, I have Mr. Arindam Mandal. He is the fund manager at Marcellus. Well, Marcellus doesn't need any sort of introduction. So let me have the privilege of introducing Arindam, and then we'll come to the topic. So prior to joining Marcellus, Arindam spent nearly a decade in the United States, working for Principal Global Investor (PGI). He started a quantitative analyst and then transitioned to fundamental research analysis. Serving as the sector analyst for US industries and utilities, Arindam oversaw India public equity investments across the equity strategies and established himself in the firm as an expert of the Indian markets because he was kind of overseeing the Indian markets from there. And prior to that, Arindam worked as lead software engineer for Oracle, which is one of the largest software company in the world, database company in the world. So he was part of the product development team there. So he holds a degree, bachelor degree in technology, which is like a first class distinction from NIT Warangal, and he received the highest honor in finance for the MBA from Duke University. So what we're going to do is today's topic is that we're going to talk about the introduction of Marcellus Global Compounder Portfolio. So we already had a couple of webinars in the past where we talked about CCP, which is consistent compounder. We talked about Rising Giant, which is more into mid and small cap, and then Little Champ, which is purely small cap fund. But that is all domestic. But today we're going to talk about what's happening in the international markets, A, and B, how this fund would help you take the maximum advantage of investing in international markets. So there are a lot of things happening before we start. There are a lot of things happening in India. So I'm sure a lot of you would know about Gift City. Through Gift City, now it has become easy for us to invest both globally as well as domestically, in the sense that there are a lot of NRIs out there and they want to participate in Indian capital markets. There are inward funds where they can invest money in dollar term and the money can be invested in India. Similarly, through Gift City, you can invest in international markets also. So those facilities have, I mean, there was a time when these things were not there, but now things have become more better. So we want to understand more about this from Arindam. So Arindam, thank you so much for accepting our request and taking time out here on your weekends.
Hi, Vikas. No problem. Always happy to talk what is going on. So yeah, as you rightly mentioned, we launched the fund a year back. So we launched it, with our own money to start with, and then eventually thought of opening it up around towards the end of March, April this year. So yeah, we just completed actually 1 year in October, end of October. So far, it's been quite interesting journey. I mean, I'm happy to go through why you thought about about this kind of product. What is the relevance for an Indian investor? Then happy to take any questions, any follow-up that you have. I think if you can keep it a little bit interactive, I think that will be better, right? So yeah, if you allow me, I can just share my screen. We had few charts that might be of interest.
Sure. So I'm making you host so that you can share the screen and share the PPT. So please bear with us, Arindam, in sharing the screen, and then we'll have the discussion. Yeah, over to you, Arindam. You're on mute.
Can you see my screen now?
Yes, we can see that.
Okay. So broadly, one way to start thinking about it is the following. As India is getting richer over time, many of our kids are actually going abroad to study. In fact, we're spending quite a bit of our expenses, buying it either iPhone, or it can be Netflix, etc. Those are basically dollar dominated denominated assets, or liabilities to that extent. So we thought about, there should be some way that you should match the asset and liability. So you should think about building some assets in US dollar, and what's the best way to do it. So of course, having investing in outside world, like there are many other markets, ETFs that are available across the board. So that is one way to just park your money in dollar denominated assets. That is one way to do it. At the same time, what we found interesting is that if you look at long-term history of equity market performance, US and India is also there, are the best performing equity markets across the globe. You take any large equity market. So what you did here is that listed down all the major markets that you hear about, and any 10, 20, 30 years, basically the longer you look at, the attraction of US equity market that actually increases over time. Of course, there are shorter period of times when you see that many markets kind of does well for 3 to 5 year, maybe 10 year, 20 year, maybe 10, 15 year, but that doesn't sustain. So our point here is that um, one should think about putting a part of their hard-earned money uh, to a little bit more less risky, but which is giving you similar kind of return over a long period of time. So that was the genesis of the portfolio. Um, And if you can talk about the US economy, etc., you all know about it. One interesting thing that came up is that if we, again, broadly, globally, markets are getting more and more correlated. There is no doubt about it. But at the same time, if we take out the big global large events like, for example, a global financial crisis in 2008-9, or a COVID kind of scenario in 2020, other than that, there is still not much of correlation. It is definitely correlated, but not much between, say, India and the US. So here we just took the indexes S&P 500 and Nifty 50 and looked at the returns. In the CAGR returns, I mean, it's actually CAGR in USD. The label is actually wrong here. So broadly, the point is that both the market has given you somewhere between 10 to 11%. And what would have happened if you just annually rebalance it? For example, 50-50, take 50% in US, take 50% in India. Then how would it look like? The interesting thing is that you don't lose much in terms of the aggregate basis. So the total return comes around 10.8, slightly higher than what the other two have done. But more importantly, your downside risk get capped because US market is less volatile relative to the Indian market. Now, as you know, the less volatile the market is, the better you can do in terms of not timing it. So if the market is more volatile, you have to time the market. But if the market is steady relatively, the timing aspect that goes away. And that is, I think, very important for any investor, that you're continuously putting your money to work. You don't have to worry about the timing aspect. So keeping that in mind, again, so we felt that there is a need for asset liability management for any Indian HNIs. And then, of course, there is a kind of proper quantitative explanation why one should do it just from the asset diversification purpose. What we tried to do is we took CCP and GCP and see, again, the same thing holds true. Now, coming about it, there are a few challenges if you think about as an Indian HNI. How do you really invest outside? Because typically, if you want to say give your money to a kind of successful American investor, then it is typically the ticket size is around $1 million. In fact, my previous firm I used to work at, we'll typically not go to kind of face any investor who is providing us less than 5 million or close to that number. So we thought that it is a good opportunity to interact with people, make them create wealth. At the same time, it is good for us. I mean, we're kind of building a new asset class in the kind of PMS format, which has not been there. Now, to build that, of course, we had to build a team. Saurav and I knew each other actually quite from long time. So when I used to work with Principal, he used to be the CEO of Ambit Capital, and he was actually one of our brokers back then. So that's how we came to know towards 2018. We kept in touch throughout these 4 or 5 years, and eventually in 2021, end of 2021, we decided to join hands and thought about this product. So that's about me. And then Jaibir used to be the head of research in Premji Invest. Again, he used to work with Saurav Rakshit in his previous avatar before Premji Invest. We kind of pitched the idea to Jaibir, and he readily accepted. This can be a good idea going forward. So the thought process was very simple, Vikas. Just try to buy good, high quality, well-run companies across US and Europe. Do relevant research, do a lot of primary research that you do for any of our domestic portfolios. Do the same. The only slight difference that approach that you adopted is in the portfolio construction side of it. So in domestic market where we do not get very high quality cyclical companies, but in the international side, we have a plethora of companies which are actually high quality as well as cyclical. So it helps us to keep a tab on the valuation aspect of our portfolio broadly. Now, again, I'm not going into the nitty gritty of it. Broadly, you start with a kind of very broad number of stocks, which is around 1,500 stocks, or I took out the banks and metals and mining, so that gives around 1,200. You apply very long-term oriented return capabilities of the companies, as well as the consistent growth both on the revenue and cash flow side. You apply that for a long time horizon, then 90% of the companies actually goes out. So that leaves us with say 80 to 85 stocks. On that, we do very deep research. It is constructed in different ways. Of course, we start with the secondary part of it, reading the annual reports, 10 20 years of annual reports. Then the second thing that we do is we actually talk to a lot of third-party research providers, not in the typical sell side type of, but we have what we call expert network services. So these are the people who help us connect to ex-employees of the companies that you're looking at, or ex-employees of the companies. They are part of the value chain, etc. So it's a kind of huge network that this companies gets us access to, and we typically talk to at least 25 to 30 of these people to get some idea or conviction about if you should work more on that particular idea. So once you do that, it gives up some idea that what is the blind spot, where should you look at next. So for example, we own a stock called Armis or Cost Queen portfolio. So we understood one thing, that China is going to be a big part of their growth story. Talking to many people, of course, reading the annual report. So we were in China actually last week. I was there with my consumer analyst and visiting the store, talking to the store manager. So point is that once you know the most important point when analyzing a company, then we can do this site visits, etc. So that gives us the quality of primary research get enhanced by quite a bit. Once you do that, we typically narrow down our stock selection, the stock portfolio, to 25 to 30 names. And as I said, it is a flavor of different characteristics. So you'll have some growth, you will have some defensive, you'll have some cyclical. And we have been doing it knowingly because there are certain part of the business cycle we tend to overweight certain group of stocks, and there are different ways to do it. And historically, what I've seen is that it adds a lot of value. Now, how does the portfolio look like in quantitative aspect? So if you look at the global consistent compounder portfolio, what you have, and these are all US dollar denominated numbers, the ROICs of these companies are way ahead of the average S&P ROICs. Their free cash flow growth per CAGR or EPS per CAGR are much higher than that of S&P. The point that we're trying to make is that if you, at the end of the day, after a very long period of time, EPS growth is the major driver of your stock price return. The kind of the re-rating of stocks, like trading at 15 times P going to 20, over time that doesn't add much value. It does sometimes, but not always. It is very hard to predict also. But at the same time, if you're looking for companies which can consistently grow their earnings over a long period of time, and if you're not overpaying for it, that is also important. Valuation is a very, it's a big part of the total investment portfolio that we have. Then you end up making a fairly good amount of wealth after five or 10 years. So that's about it. Again, I can go through it. We actually, if you know Marcellus, then you probably know that we are very paranoid about understanding the moats of different companies, and the moats have to be multi-layered. It is not just one or like just a single layer. For example, if you take a company like ASML, people who have heard us before, we talk about it a lot. The ASML is basically a kind of a monopoly or quasi-monopoly in lithography chip manufacturing. So lithography is a process in chip manufacturing where they're basically printing the printing the transistors into a silicon wafer. And these are like incredibly complicated process, very hard to make the machine. And ASML built it over many years, very hard to get the technology right. But that is one part of it. The reason we like ASML is that as they're getting the technology right, at the same time, they are actually building equity stake in many of their suppliers. Now, the point is that many of these suppliers are actually sole source for ASML. Now, if someone comes in and breaks through the technology, it will be very hard to source the supplier to make that kind of certain component. So again, multiple layers of moats are built into all the companies that we have in the portfolio. Uh, Again, we talked about, you can skip this. It is about the valuation thing, because you that I talked about, that finding right companies is half the job done. But we have seen that historically it has been a challenge for any portfolio manager, that many times those companies get very overvalued. Now, as a portfolio manager, we need to make sure that we really acknowledge the quality of those companies, but at the same time, there's one way to play around it is you adjust your weights in the portfolio. That's what we try to do. And as I said, we have different flavors of companies in the portfolio, the 25 to 30 stock that we'll see. Uh, when there is a heavy disconnect between, say, quality versus growth versus value, again, both are all our quality companies, we try to make sure that they're converging in terms of position sizing. That adds a lot of value over time. Uh, that is pretty much about it. Now, as I said, we launched it last year, and this is how the portfolio has done over last 13 months. I think this is, yeah, over 13 months. More importantly, Vikasji, the important thing I think your viewer should understand here is that most of the growth that has come here is despite most of the return, actually, despite not holding most of the the magnificent seven that people talk about these days, like Apple, Microsoft, Amazon. We own these three, but we don't have any position in Nvidia, Meta, Google, or Tesla. Even the three that you own were actually heavily underweight. But despite that, the portfolio did actually pretty well, and most of it has come through just better earnings growth. And the portfolio has not re-rated relative to the index. So that is one way we kind of keep an eye on valuation, that if index is trading at X times, our stocks are trading at, say, 1.5 times of that X. Even now they're trading at same level. So index might relate, we do not have much control over it, but kind of keep an eye that on relative to index how our stock valuations are. So that hasn't changed much in 1 year, so that is good news. So broadly, that's where we stand. We are typically looking for a kind of gross of everything, 6 to 9 points of alpha over kind of S&P 500. And S&P 500's long-term history is 9 to 10% of USD CAGR. Now, if we think about to take out the fees, and there is, of course, it's a kind of penal for Indian investors. in terms of tax, because the long-term gain and short-term gains are a little bit different compared to the Indian equities. So you can shave off, say, 3 to 4 points from the final return. So what we are targeting, net of everything, we should do better than S&P by 3 to 4 points over a 5-year cycle CAGR. So that's how we constructed the product. That's thankfully the product has done so far, and we hope to maintain that momentum. So with that, Vikas, let's conclude the initial remarks. Happy to take questions.
Yeah, so couple of questions. So one is, how many companies do you hold in your portfolio?
We have 28. It will always be 25 to 30.
And so, Arindam, I wanted you to throw some more lights initially to give our audience a perspective that why one should not only focus on India. So India का story तो ठीक लग रहा है. I mean, no denying on that. But can you also throw some more lights on why should somebody diversify the portfolio?
India story is very good. I mean, there is no doubt about it. But another question that we can ask is, I think, why you should always invest in US portfolio. That is one way to think about it. There are certain benefits that US tend to have. It is a long-term structural benefit, and that is the reason that US story has been running for last actually 100 years, right? The 9 to 10% CAGR that you're talking about, that has been like for 100 years. It is not a short-term story. So my point here is that there is nothing wrong with the India story. It is great, and India story has been great for last 20, 30 years also. It is, it started from such a low base after we came out of the 91 policy shift. That has been a great story. And if you look at the last 30 years, I mean, we had this chart, right? Uh, India has done pretty well. I mean, if you look at any other global market, none of the other companies actually can, none of other countries can match it except US. Now, my point here is that throughout these last 30 years, uh, India's GDP growth is much higher than, has been much higher than that of US. Okay. China's GDP growth even higher than India. Despite all of that, US equity market actually grows, has provided actually similar kind of result compared to India. The point is that you always find great capital allocators in the US, and that is the reason that the market tends to do well. It's a free market. It has one of the most important assets in the world, which is human capital. So they tend to attract the best of minds across the globe. It's very hard to match that. So once you have that, you can actually create newer set of products, newer set of technologies, newer set of productivity methods that helps these companies to prosper over time. It's very hard to change that thing, Vikasji. If you look at any countries across the world, um, you just you find like I think 70% of the top universities across the globe, those are in the US. Now, when you have the best of people working there, you have the best research and development that is going on. It's very hard to compete. It's a moat that US has created. India's story is phenomenal, no doubt about it, but you cannot deny the moat that US has. Second thing, people talk about the de-dollarization. I think it is far off, to be very specific. De-dollarization, uh, to to accept a country's currency as a reserve currency, you have to make sure that the country has no capital control. Now, yes, largest competitor is basically China, which is a capital control country. So it is hard to imagine someone taking over, some other currency taking over in such a short term. Typically, the currency shift happened when there is a war. If that is the case, then of course it is possible. But otherwise, it is, as long as US is maintaining its dominance in global trade and global GDP share, it's very hard to imagine how US dollar can be dethroned. Now, as long as US dollar is the reserve currency, it's a very powerful tool uh, to keep the economy in line. So to that point, again, I'm saying that over 5-10 years, some country can do better than others. But if you're taking a longer term view, US is a phenomenal country to invest in, and that's why a certain part of your portfolio should be allocated to those assets.
So basically, US and China, this chart, the table that you're talking about, clearly indicates that on a 10-year basis, US is at number one and India is at number two, right?
Yes, 10, 20, 30. That's it. I mean, so the two best countries, just put your money there.
Surprisingly, or your China is slowing down. It has come to now what eighth position on 10-year basis,
Yeah.
and this data is on August 2023, right?
Yeah. So that is the challenge. I mean, let me see if I can find out another chart later on, but that is the challenge that we have seen in many emerging countries. For example, of course, China had a great run between early 90s to 2006. Then it just 2006, 7. Then last 15 years, it didn't do anything. And despite having tremendous GDP growth. Similarly, Japan had a good run between 1960, 70 to 1980s. Then for again next 30 years, it didn't do much. So that is a typical challenge that comes to different countries. The points that I told you about US, the kind of institutions are so strong that it actually helps the machine going.
And US is no more US alone. It's the entire globe. I mean, all the big
Yeah,
companies, you look at their revenues
diversified.
from
Yes,
country like India, so your Facebook, Apple, look at their major revenue source is India. And not only India, in fact, there are other emerging markets also. So ultimately, I would say that US is no more US alone. It's an
abs
entire globe. Uh,
absolutely. And they are actually capturing the highest value chain, highest value part in the entire value chain. So, for example, if you think about Apple, right, 45% of their sales is actually from Asia, actually more than that. Half of it is in from Asia, and its market cap is $3 trillion. Okay. Now, Foxconn makes all the phones for Apple, most of the phones. Apple's market cap is 3 trillion. Foxconn's market cap is $50 billion. So, like they are basically all their companies that you talked about, Meta, etc. They are actually capturing the most valuable part in the entire chain. So, people can say that, okay, we are making iPhone, etc., etc. It's fine, but that is not the most important part of the value creation.
This is just one thought which has come in my mind, Arindam, while talking to you. I am trying to visualize 10, 15, 20 years down the line. You will see these startups growing to this extent, our Indian startups, and they become conglomerate in terms of like their market valuations. And then you see where India's valuation would go up. So probably it will be number one, I would say, in terms of size as well as the percentage. Percentage wise is very good. Uh, okay, coming back to point, so what is the minimum threshold? How much money you take, and money would be taken in Indian rupee or in dollar term? How does this work?
Right. So it is a gift city product. So we typically do not take in US like INR. You have to transfer the money in USD. So you have to tell your bank that I want this much amount to get transferred to my USD, something like that, and then it will be transferred to the pool account for Marcellus. So the PMS setup that we have, it is around. It is the minimum threshold is 150,000. It is not our threshold, $150,000. It is the IFSCA mandated minimum, regulatory minimum. Now, what we understood is that it is probably better to, if you can, given that you cannot time market, if you can, put the money in different, say, in a block of little bit smaller chunks, right? So that we are trying to explore. So we explored something called Crystal, is a platform based out of Singapore, where you can put 25,000 minimum and you can top it up basically going forward. So that is another platform we explored. Again, it is only for accredited investors now. So we are still working that if we can make it available for all. So these are the two avenues to invest in this product.
Right. So my sense is that so what one should really diversify. Somebody who's investing in PMS, $150,000 is not a big deal for them to diversify. But if
Yeah.
someone really wants to start and see how it is shaping up, of course, they can take the benefit of this platform, Crystal. We also have a tie up with them. And we can start with $25,000 and then build the position on, and keep investing. So, okay. So, can you also talk to us about the last time we talked about there are companies like Amazon that you buy or Microsoft that you buy, and there are companies that you do not buy. So on what basis do you select these businesses, uh, and uh, and how many years you hold on, or you don't have a criteria like that? Depending upon the valuation, you will change.
Yeah. Can you hear me?
Yeah.
Yeah. So the criteria are actually fairly simple that you should have a long history of displaying dominance in whatever sector that you are. We are sector agnostic in that front. Let me just go through it. One second. Yeah. So the first thing is the quantitative criteria is fairly rigid. And you are looking at 7-8 years of profitable growth with high return on capital. And the return on capital is not your typical ROC. What you're looking at is the cash flow from operations to invested capital. Okay, so why we do that? Because we have seen that many companies they tend to, for example, Amazon, they didn't make return actually the profit for a long period of time. But if you look at the business, it has been generating cash flow for a long time. I think they have been cash flow positive since 2005, and they have not been generating profit. It is their choice. If they want to generate, they can. Okay, so there are companies which are investing a lot, they're generating cash. We want to give them the benefit of doubt. So an Amazon kind of company would come into a screener, let's say 2006-7, and we are happy to miss that initial 5-6 years. The reason is very simple. We want to basically, if you look at this chart, uh, yeah, if you look at this chart, we are very focused on longevity. So if a company has displayed or demonstrated a long history of profitable growth in their past, and if we think that they have the scope to deliver that kind of outside growth kind of going forward, either it be market penetration or capital allocation, whatever it can be, uh, if you have demonstrated a good history, there is a higher chance that you will be doing good given the opportunities. Okay, so that is how we select companies. Now, we the reason, for example, we did not select Nvidia in our portfolio, it cleared most of our filters. Fundamentally, we did a lot of work on it. We are just not comfortable with valuation. The stock was trading at around 300 or something like that. Of course, it went to 500, so we are probably wrong in that standpoint. But this is a cyclical company, and we strongly believe that you get opportunity to buy them at a reasonable price. So chasing price is something that we do not want to do. We keep a vault of ideas, and Nvidia is in that vault of ideas. So when the price is cheaper, and if you think that the potential, the margin of safety, whichever way you put it, is higher than the stocks that you have in our portfolio, we definitely take a call. Similarly, now if you think about a company like Meta, uh, it didn't clear our screener last year. The reason is very simple. Every 4 or 5 years, they come out and rejig their operating margin numbers. It's just the nature of the business because it is social media advertising business. People's preference change. So every 4 to 5 years, they have to go through a high capex cycle. 4 or 5 years back, it was building some of their internal platform. This time it was AR, VR. So you're not comfortable with that kind of shifts, to be very fair. We have great respect for the company, but as I said, we are looking for a bit of boring, but predictable kind of companies which can give me that 15% CAGR that you're looking for, and with reasonable valuation. So that's how we select companies.
So what would be the percentage of large cap, mid cap, and small cap in the overall portfolio, and how would it change? It is a bottom up approach, or you will be
Ye-
looking at changing it? And what is the current structure now, current bifurcation of large, mid, and small?
Yes, so Actually, we're in that slide only. So if you think about our portfolio, the GCP portfolio, this one actually, uh, mid cap and small cap is around. Sorry, the light went off. So mid cap and small cap is around 55 to 60% of the portfolio. Okay, so that is, we have not tried to maintain anything, to be very honest. It is purely bottom up, and that's how it came up. What we wanted to make sure is that we are not trying to hug the index, which is the easy way to do things. It doesn't mean that we do not respect the large companies, we do. But again, we wanted to keep it very bottom up, and that this outcome, that 55% mid cap or smaller, is an outcome of that. Uh, and if you compare that with the index, you can see that the mega caps, and the large cap is actually around 80% of the over the S&P 500.
Okay. So what would be the market cap put together vis-a-vis the benchmark?
I have to see that. It is actually way lower, I would say. I don't have the data in front of me right now, but it will be way lower. And the mid cap is see, mid cap is actually very different from Indian mid cap. So the mid cap in US context, they're talking about 15, $20 billion market cap companies. So what we try to maintain is that it should be fairly liquid companies, so that we are not taking any trading risk.
So basically, our large cap would be equivalent to their mid caps, is it?
Yeah, it is fair to put that. So, for example, when you say mega cap, it is basically the companies above 250 billion market cap. When you did large cap, is basically 50 to 250 billion dollar market cap, and this mid cap is 10 to 50.
Sure. Understood.
Yeah.
So you are through this chart, you are essentially trying to say that this mega cap, which is 20%, can become 46% because you're saying that after 16 years down the line, their survival rate increases and they become large organization. Is that this is how the value migration takes place in US?
Uh, it does. So things have changed a bit in the US. I mean, typically, what you'd see, that the small cap index used to do better than the large cap over a long period of time, but that stopped around 2010-11. So last 12 years, we have seen a major rally in large cap, and typically because of the business models to some extent. So for example, the tech business model in the recent time has always been like winner take all. If you think about Apple or Meta, etc., the business models are like that. If you're in a social network, one guy grabs most of it. Going forward, very hard to say, but typically, in long period of time, the smaller caps tend to take the bigger share. You see the migration, like it happens in India also. Over a long period of time, small cap tends to do well. That has been the case in US as well. Last 10 years has been different. I do not really know that, if that will stay the same or not.
Yeah.
But what we try to do is that, not to kind of pick our brain on that. It's very hard to do. Just try to figure out the companies where you can easily, like fairly easily, you can make a case for 15% compounding in dollar terms. If that is the case, what I've seen is that that's a neglected area of the market to some extent in the mid cap space, that people don't talk about that because they're not giving you 20-25% kind of growth. So the valuation remains reasonable, right? So that gives you some leeway, kind of, sweet spot to play. That's what we're trying to capture.
The other thing, Arindam, there are lot of domestic investors. They're keen to look at other markets, especially US. But point is, they say that look, domestically, I know I'm kind of familiar with what's happening, but at times I keep hearing a lot of bad news about US that the recession has begun and all that. So, can you talk to us about the structural growth of the economy, how it is looking like next 10 years down the line, 20 years down the line, or maybe last 10 years would be the referral data, and then you want to draw a picture about next 10, 20 years, and then compare this with India.
So you're right. The macro angle is very different. So if you think about what happened in the US, typically, okay, let me put it in this way. US is the only country which will see population growth in next 15-20 years also. So they are still, because the immigration because of immigration, they still see the inflow of a lot of young people. So that helps, to keep the economy growing at a reasonable pace. Rest of the other developed world, as you know, the economy is basically kind of shrinking. The population is shrinking. So in that sense, US still stands tall. The chances of recession, look, I mean, I was fairly surprised the way the US economy held up this year. In fact, how the global economy held up this year, given what the rates were, there are serious chances of slowdown. There are signs of slowdown, but it was not that evident. The job market still held up pretty well. Now, what we do not know is what is going to happen next year. And to be very honest, I really do not want to predict that. What I really know is that this economy has seen many ups and downs, and there will be many ups and downs even going forward. So, whatever may be the case, as long as I get a reasonable valuation for the market as well as the equities, and if I have a 5 to 10 year view, I am happy to invest more and more in the market. That's the view I take. On India's standpoint, I mean, I think India is in a very sweet spot. As you mentioned, a lot of things are going correct for the country, which is fine, which is great, which is kind of showing up in their valuation as well. I think Indian market is kind of 20% higher. Their P is, I think, 20% higher than even US actually.
Right.
So it's fine. I mean, if there are a lot of things going positive, and it is kind of getting reflected in the valuation, which is great. As I said, I'm happy to divide my wealth between these two countries, given that the earnings growth would be there for these countries, for the companies
Can
that
you
they have.
also talk to us about the interest rate cycles, both for US as well as India? And do you see any correlation?
Not really. There hasn't been any, to be very honest. In fact, for US drive the interest rate in many other countries, but not that much for India actually. India has been very on its own kind of situation for a long, long period of time. Partly it is because it is a more domestic consumption driven economy, partly because India doesn't have too much of external debt, which is actually great. So it can define its own fiscal policy or monetary policies. So that way it has been fine. Going forward, I think India's interest rates are going to go down from wherever we are. We're kind of reaching that cycle. And if you think about it, the delta, the amount of interest rate hike that we have seen in India has been much lower that of in the US. It's quite unique. And in the US also, I mean, I think the consensus is that we have reached the peak of the cycle. So even that is going to come down going forward, and that is showing up in the the recent rally in last 1 month or so. That's kind of reflecting there. But to your point, I think the interest rate cycles are very different from India versus US. At least the drivers are actually very different. If you think about it, I think India's inflation will be much more under control vis-a-vis that of US, because we do not have a labor problem here. In US, that's a serious issue. You do not find labor that easily. Now, the impact on an index like S&P is probably going to be a little lighter. Just the reason being, S&P is the largest weights in S&P. They are asset-light companies. They're not asset-heavy companies. So the impact on asset-heavy industries will be much higher when you are going through this kind of inflation cycle. But anyways, broadly, the point is uh, the macroeconomic cycle where we are, India is definitely in a very sweet spot where we stand now.
So my last question, can you also throw some more lights on last month, what has happened in the US when we saw a 0% coupon rate, all that bond, the yield suddenly, dramatically went up and then eventually came down and we saw equity started rallying. So any correlation, people are saying that this happened after 60, 70 years and all that. So any news that you're following?
It is a reset of the discount rate. That's how we can see it. It's a reset of the discount rate, and the market is actually much more efficient now in pricing in these kind of things. That's what my understanding has been. So market very quickly reacts once they saw that there is a chance that the CPI numbers that came out of US that was slowing down. It came to I think 3% or so. So that gave people comfort that we are probably out of that 5-6% inflation people are talking about. That could be really harmful for the economy, to be very honest. So when that was out of the window, then kind of Mr. Powell came out and kind of gave some idea that we had done rising interest rate. So that gave people comfort in terms of doing their discount rate calculation. And if you think about it, you can just take out 100 points from your denominator in terms of the discount rate that you put out. That gives you a 15% to 20% of uplift in your equity valuation. To some extent, that's what people did. Now going forward, they corrected the discount rate, but what we have not seen yet is the impact of the higher interest rate, if that has any impact on the economy next year. We'll see how that plays out. But right now, I think what people have done is just take the basic calculation. That's what is always the case. But this time it has been really quick. Within just 6 weeks, we saw this massive rally. But again, that's why I never try to time the market, to be very honest. You just have to be in the market to take advantage of this kind of situation.
True, true, true. No, that was very good movement, I would say. So I have been following this market very closely, and I really saw the way. I mean, you've shown your kind of performance it has come both on the benchmark side as well as your.
Yeah,
So that.
right.
So all right, with that, we'll like to conclude the session here. I think it was great reading your mind, Arindam. You've been tracking US market so closely. I'm glad to know that, and keep up the good work. Keep
Oh, thank you.
the good results in the hand of our investors. So those who are interested to know more about this fund, they can reach out to my team at aifpms.com and fix up an appointment. And if needed, we'll get Arindam also on the call and try and give you more understanding about that. But yes, you should diversify as we move ahead. Thank you.
Perfect. Thank you.